Danny LeBeau. Welcome back to the Fourth Revolution, where I discuss stocks for your portfolio of the future. And these innovation-driven stocks have had a tremendous pullback since roughly February 16th, with NASDAQ down nearly 10%. And a lot of the cyclicals keeping the broader market buoyant for the most part, with S&P 500 down just over 4% in that same time frame. But we're hitting some levels today that I would like to discuss. I'd also like to break down exactly what's driving this. It seems like we've bought the rumor of this economic reopening for, the last 52 weeks, and then all of a sudden things look super promising with Biden coming out saying that we're going to have all the willing adults vaccinated by the end of May, or at least have the capacity to do so with all the vaccines coming out, with the J&J and Merck working together, along with Moderna as well as Pfizer. And, what happened is people were like, okay, we got an economic reopening. We got to reevaluate some of our frothy holdings, which include tech, which I thought had a pullback on the horizon from the get-go here. And we're already seeing, like I said, 10% pullback, and you're seeing it from the most stretched names. And this is going to be exemplified with Cathie Wood's ARK ETF, which is, the innovation-driven ETF with some of the most, I guess you could say, stretched multiples, seeing a 25% decline from its peak. So let's take a look at the charts and see where we're headed and see where this buying opportunity is, because every pullback has its buy the dip opportunities. So let's jump into the charts here. Seen a ton of volatility today, with the NASDAQ 100 really driving it. The innovation propelled stocks have really been reassessing what level they should be trading at, with froth kind of being blown off the top. Like I said, the NASDAQ 100 dipped roughly 10% from its highs on February 16th. And the S&P 500 has remained relatively buoyant, with the cyclical underperforming stocks of 2020 really paving the way as they outperform tech since the beginning of 2021. But check out this trend line here that we just broke through. If I can hit it, we just broke through this trend line in futures. This is a trend line that has held pretty much since our lows in last March, and we broke through it today, earlier today, with tech obviously driving the downside. And I think this could be an issue moving forward. We have this buy the dip mentality, and you can see it right here with the NASDAQ 100 bottoming out at 12,500, and this new wave of retail investors has this bullish sentiment that just seems to have no end. No matter how hard the big tech stocks are pounded, they will continue to buy the dip. And this was a technical buy right here at our 23.6% negative retracement, should I say. I took our lows from mid-January to our highs on February 16th, like I discussed, and we hit this level today. And, we're still trading all over the board. There's no way to really define where this downtrend is going to end, but I think we may have hit a daily low. But I'm still, a little bit apprehensive. I know I've said in the past that I would buy this 12,500 level, but I think that we could still fall further. Like I said, analysts are calling for a 10 to 15% pullback, and the S&P 500 is down less than 4% now from its highs. So I think that, with reflation really driving a lot of the growth, I think those stocks are even, been pushed a little bit too far. You can see the KBW ETF here, which is the bank ETF, is hitting all-time highs, or should I say did hit all-time highs this week. And I think this might be a little bit overdone, with yields remaining, still below our industry average, and the Fed vowing to keep their Fed funds rate at or near zero for the indefinite future, and letting inflation run. So I think we've priced in a little bit too much of this reflation trade. And you can see it even with energy. energy stocks are up a tremendous amount, and the world is turning away from oil, and this is obviously an oil-driven ETF. But oil prices have driven above $60 a barrel, and I think this is a little bit overdone. Cathie Wood's ARK ETF really epitomizes the COVID winners with the most stretched valuations. You can see her ETF is really taking a hit, dropping to its lowest level all year today. From its high, it was over a 25% loss at its low from its high, and this is because its holdings include Tesla, Square, Roku, Teladoc Health, Zillow, Shopify, CRISPR, all these, valuation stretched companies that are really relying on this low interest rate and these low yields because, analysts are obviously looking way into the future. The lower the yields are and the lower the discount. So these companies were able to rise up and, as far as valuation multiples go, to their highest level in history. And now, obviously asset managers are reassessing that with yields going up and inflation on the horizon. So this, like I said, is epitomizing what we're seeing in the markets today as far as valuation cuts go. So Cathie Wood's ARK portfolio, like I said, really epitomizes what's happening in the markets today with the valuations being cut. And this was anticipated by analysts across the board. But there is going to be opportunity, and you saw it today. And these retail investors are really jumping into the markets with 20% of the daily volume being driven by this new cohort of traders. And they are not concerned about valuation in the long term, even with yields jumping up to 1.5% as far as the 10-year Treasury benchmark goes. So thanks for watching, guys. Don't forget to check out Zacks.com/promo with our latest promotion being Marijuana Innovators. And, with a blue wave hitting the federal government, legalization has never been closer. So don't forget to check that out at Zacks.com/promo. Thanks for watching, guys.